Do you want to successfully complete the D102 Objective Assessment exam? Then you are in the right place. Our website provides a list of questions and answers for your success in the D102 OA exam for free. We understand that acing your OA exam can be quite challenging. That's why we provide completely free exam guides and practice questions for you. In this video, we will cover questions from accounting fundamentals, financial statements, accounting entries, costing methods, and asset accounting. So, let's get started. 1. Which account normally has a debit balance? A. Sales. B. Dividends. C. Accounts payable. D. Accumulated depreciation. What do you think is the answer? Correct answer. B. Dividends. Explanation: option B is correct because the dividends account normally has a debit balance. Dividends are money paid out to owners, which reduces the company's equity. Since equity increases with a credit, something that reduces equity will have a debit balance. Option A is incorrect because sales is a revenue account, so it normally has a credit balance. Option C is incorrect because accounts payable is a liability, so it normally has a credit balance. Option D is incorrect because accumulated depreciation is a contra asset, so it normally has a credit balance. 2. How does a company record the payment of salaries to its employees? A. Debit salaries expense, credit cash. B. Debit cash, credit salaries expense. C. Debit salaries expense, credit accounts payable. D. Debit accounts payable, credit cash. What do you think is the answer? Correct answer. A. Debit salaries expense, credit cash. Explanation: option A is correct because when a company pays its employees, the company has an expense, salaries expense, that increases with a debit, and the company's cash goes down, which is an asset that decreases with a credit. Option B is incorrect because it reverses the correct entry. Debiting cash would imply an increase in cash, and crediting salaries expense would reduce the expense. Option C is incorrect because it would be used if the expense was recorded now, but planned to be paid later, creating a liability. Option D is incorrect because it would be used if paying off a previously recorded salary liability. 3. What is the effect on the accounting equation when a company borrows cash by signing a note payable? A. Decreases assets, decreases liabilities. B. Increases assets, increases liabilities. C. Increases assets, increases equity. D. Decreases assets, decreases equity. Do you know the answer? Correct answer. B. Increases assets, increases liabilities. Explanation: option B is correct because the accounting equation is assets equals liabilities plus equity. When a company borrows cash by signing a note payable, its cash, an asset, goes up because it received money, and its notes payable, a liability, also goes up because it now has a debt to repay. Option A is incorrect because borrowing cash increases assets, not decreases them. Option C is incorrect because borrowing cash increases liabilities, not equity. Option D is incorrect because borrowing cash increases assets and liabilities. It does not decrease them. 4. How are revenues typically recorded with debits and credits? A. As a debit. B. As a credit. C. As a debit when earned and as a credit when received. D. As a credit when earned and as a debit when received. Can you guess the answer? Correct answer. B. As a credit. Explanation: option B is correct because revenues, money a company earns from its business activities, like sales, increase the company's equity, the owner's stake. Since equity accounts normally increase with a credit, revenue accounts are also increased with a credit. So when a company earns revenue, it records it as a credit. Option A is incorrect because revenues increase with a credit, not a debit. Option C is incorrect because revenues are credited when earned, and the receipt of cash is a separate entry. Option D is incorrect because revenues are credited when earned, and the receipt of cash would involve a debit to a cash account. 5. On September 1st, a company received $12,000 in advance for services to be provided over the next year. What is the correct adjusting entry at the end of December? A. Debit cash, credit unearned revenue. B. Debit unearned revenue, credit service revenue. C. Debit service revenue, credit unearned revenue. D. Debit accounts receivable, credit service revenue. Do you know the answer? Correct answer. B. Debit unearned revenue, credit service revenue. Explanation. Option B is correct because when the company first received the $12,000, it had not performed the services, so it was unearned revenue. By the end of December, 4 months have passed, and the company has earned 4/12 of the $12,000, which is $4,000. The adjusting entry needs to decrease unearned revenue by $4,000 and increase service revenue by $4,000. Option A is incorrect because this entry reflects when cash is first received, not the adjusting entry. Option C is incorrect because this entry is backwards, debiting service revenue and crediting unearned revenue, which is not the correct adjustment. Option D is incorrect because this entry is used for a credit sale, not for adjusting unearned revenue. 6. Which of the following is classified as a long-term liability? A. Accounts payable. B. Accrued expenses. C. Bonds payable. D. Salaries payable. Do you know the answer? Correct answer, C. Bonds payable. Explanation. Option C is correct because long-term liabilities are debts or obligations that a company expects to pay off in more than 1 year. Bonds payable are often issued by companies to borrow large amounts of money for many years, so they are a classic example of a long-term liability. Option A is incorrect because accounts payable are usually current liabilities because they are due within 1 year. Option B is incorrect because accrued expenses are usually current liabilities because they are due within 1 year. Option D is incorrect because salaries payable are usually current liabilities because they are due within 1 year. 7. Which inventory costing method assumes the first items purchased are the first to be sold? A. FIFO. B. LIFO. C. Weighted average. D. Specific identification. Can you guess the answer? Correct answer, A. FIFO. Explanation. Option A is correct because FIFO stands for first in, first out. This inventory costing method assumes that the oldest items a company bought or made are the first ones it sells. So the cost of the items sold is based on the cost of the oldest inventory, and the items left in inventory at the end are assumed to be the newest ones. Option B is incorrect because LIFO is last in, first out, meaning the newest items are sold first. Option C is incorrect because the weighted average method uses an average cost to determine the value of items sold. Option D is incorrect because specific identification tracks the actual cost of each specific item sold and is used for unique, high-value items. 8. What type of account is accumulated depreciation? A. Expense account. B. Contra asset account. C. Liability account. D. Asset account. Can you guess the answer? correct answer B. Contra asset account. Explanation. Option B is correct because accumulated depreciation is a contra asset account. Contra means against or opposite. An asset account normally has a debit balance, but accumulated depreciation has a credit balance. It's subtracted from the original cost of a long-term asset on the balance sheet to show the asset's book value, which is its cost minus all the depreciation taken so far. Option A is incorrect because depreciation expense, not accumulated depreciation, is the expense account recorded each period. Option C is incorrect because accumulated depreciation is not a liability. It doesn't represent an obligation to pay someone. Option D is incorrect because while it relates to an asset, it reduces the asset's value, not directly representing an asset itself. 9. What is the proper accounting treatment for a cash dividend declared but not yet paid? A. Debit dividends, credit cash. B. Debit dividends payable, credit cash. C. Debit dividends, credit dividends payable. D. Debit retained earnings, credit dividends payable. What do you think is the answer? Correct answer C. Debit dividends, credit dividends payable. Explanation. Option C is correct, because when a company's board of directors officially declares that it will pay a cash dividend to its shareholders, the company creates an obligation to pay, so it records a liability called dividends payable, and the dividends account is increased. Option A is incorrect because this is the entry when the dividend is paid, not when declared. Option B is incorrect because debiting dividends payable and crediting cash occurs when the dividend is actually paid. Option D is incorrect because retained earnings is debited when the dividends account is closed at year end. The direct entry at declaration involves the dividends account. 10. Which financial statement reports the financial position of a company at a specific point in time? A. Income statement. B. Balance sheet. C. Statement of cash flows. D. Statement of retained earnings. What do you think is the answer? Correct answer B. Balance sheet. Explanation. Option B is correct because the balance sheet is like a financial snapshot of a company. It shows exactly what the company owns, what it owes to others, and what the owner's stake in the company is on one particular day. It's a picture of its financial position at that specific moment. Option A is incorrect because the income statement shows profit over a period of time, not at a single point. Option C is incorrect because the statement of cash flows shows how cash moved in and out over a period, not at a single point. Option D is incorrect because the statement of retained earnings shows changes in accumulated profits over a period, not at a single point. 11. Which method of depreciation results in the same depreciation expense each year? A. Units of production. B. Declining balance. C. Straight line. D. Double declining balance. Can you guess the answer? Correct answer C. Straight line. Explanation. Option C is correct because the straight line method of depreciation is the simplest way to calculate it. You take the cost of the asset, subtract any expected salvage value, and then divide that amount by the number of years you expect to use the asset. This gives you the same equal amount of depreciation expense to record every single year. Option A is incorrect because the units of production method bases depreciation on how much the asset is used, which varies each year. Option B is incorrect because the declining balance method is an accelerated method where more depreciation is taken in the early years and less in later years. Option D is incorrect because the double declining balance method is also an accelerated method where more depreciation is taken in the early years and less in later years at twice the rate of the declining balance method. 12. What type of asset is a patent classified as? A. Tangible asset. B. Intangible asset. C. Current asset. D. Financial asset. Do you know the answer? Correct answer, B. Intangible asset. Explanation: option B is correct because an intangible asset is something valuable that a company owns, but that you can't physically touch or see. A patent is a legal right granted by the government that gives an inventor the exclusive right to make, use, and sell their invention for a certain number of years. Since it's a right and not a physical object, it's an intangible asset. Option A is incorrect because a tangible asset is something physical, like a building or machine. Option C is incorrect because a current asset is expected to be used or converted to cash within a year, and patents are long-term. Option D is incorrect because a financial asset includes things like cash, stocks, or bonds, which are different from intellectual property rights. 13. What is the formula for calculating net income? A. Revenues minus expenses. B. Revenues minus cost of goods sold. C. Assets minus liabilities. D. Cash inflows minus cash outflows. Do you know the answer? Correct answer. A. Revenues minus expenses. Explanation: option A is correct because net income, also called profit or earnings, is what a company has left over after it has paid all its bills for a certain period. You calculate it by taking all the money the company earned from its business activities and then subtracting all the costs and expenses it had to pay to earn that revenue. Option B is incorrect because revenues minus cost of goods sold gives you gross profit. Option C is incorrect because assets minus liabilities equals equity. Option D is incorrect because cash inflows minus cash. Outflows is related to cash flow, not net income on an accrual basis. 14. Which principle requires that expenses be recognised in the same period as the related revenues? A. Revenue recognition principle. B. Matching principle. C. Cost principle. D. Consistency principle. What do you think is the answer? Correct answer, B. Matching principle. Explanation: option B is correct because the matching principle is a rule in accrual accounting. It says that a company should record its expenses in the same accounting period as the revenues that those expenses help to generate, or earn to match the costs with the income they helped produce. Option A is incorrect because the revenue recognition principle dictates when to record revenue, not expenses. Option C is incorrect because the cost principle states that assets are recorded at their historical cost. Option D is incorrect because the consistency principle says a company should use the same accounting methods from period to period. 15. Which account is closed at the end of the accounting period? A. Equipment. B. Retained earnings. C. Sales revenue. D. Accounts payable. Can you guess the answer? Correct answer, C. Sales revenue. Explanation: option C is correct because sales revenue is a temporary account that tracks financial activity for only one accounting period. At the end of that period, its balance is closed out by transferring it to a permanent equity account, usually retained earnings, to get it ready for the next accounting period. Option A is incorrect because equipment is a permanent account found on the balance sheet. and its balance carries forward from one period to the next. Option B is incorrect, because retained earnings is a permanent account found on the balance sheet, and its balance carries forward from one period to the next. Option D is incorrect because accounts payable is a permanent account found on the balance sheet, and its balance carries forward from one period to the next. 16. On December 31st, a company recognized $2,000 in wages earned by employees but not yet paid. What is the correct adjusting entry? A. Debit wages expense, credit wages payable. B. Debit wages expense, credit cash. C. Debit cash, credit wages payable. D. Debit wages payable, credit wages expense. Do you know the answer? Correct answer, A. Debit wages expense, credit wages payable. Explanation. Option A is correct because at the end of the accounting period, the company needs to record the fact that its employees have worked and earned $2,000 in wages, even if they haven't been paid yet. This is an accrued expense. The company has incurred an expense, wages expense, which increases with a debit. The company now owes this money to its employees, so it has a liability called wages payable, which increases with a credit. Option B is incorrect because debiting wages expense and crediting cash would be the correct entry if cash was paid immediately, but the wages are not yet paid. Option C is incorrect because debiting cash and crediting wages payable would imply the company received cash and increased its obligation to pay wages, which is not the scenario described. Option D is incorrect because debiting wages payable and crediting wages expense would decrease both the liability and the expense, which doesn't accurately reflect the accrual of unpaid wages. 17. How are research and development costs typically treated? A. Expensed when incurred. B. Capitalized as an intangible asset. C. Expensed over the life of the project. D. Expensed only when the project is completed. Can you guess the answer? Correct answer, A. Expensed when incurred. Explanation. Option A is correct because under US generally accepted accounting principles, most research and development costs are treated as expenses in the period they happen. This is because it's often very uncertain whether research and development activities will actually lead to a successful new product or a future economic benefit. There are some very specific, limited exceptions where development costs might be capitalized, but the general rule is to expense research and development. Option B is incorrect because capitalizing research and development costs is generally not allowed under US generally accepted accounting principles due to the uncertainty of future benefits. Option C is incorrect because expensing research and development costs over the life of the project is not the typical treatment under US generally accepted accounting principles. Option D is incorrect because research and development costs are expensed as they are incurred, not only when the project is completed. 18. What does a debit entry to an asset account represent? A. An increase. B. A decrease. C. No effect. D. A transfer to equity. Can you guess the answer? Correct answer, A. An increase. Explanation. Option A is correct because in double-entry bookkeeping, different types of accounts increase or decrease with debits and credits. For asset accounts, a debit entry always means the balance of that asset account is increasing. A credit entry means it's decreasing. Option B is incorrect because a debit to an asset account increases the asset's value, while a credit decreases it. Option C is incorrect because a debit always has an effect, either increasing the asset account if it's an asset, or decreasing it if it's a liability or equity account. Option D is incorrect because a debit to an asset account does not transfer anything to equity, Such a transfer would typically involve a credit to the equity account. 19. Which account is used to record the costs of purchasing inventory? A. Sales. B. Cost of goods sold. C. Accounts payable. D. Retained earnings. Do you know the answer? Correct answer, B. Cost of goods sold. Explanation. Option B is correct because when a company sells some of its inventory to a customer, the cost that the company originally paid for that inventory is then recorded as an expense called cost of goods sold on the income statement. Option A is incorrect because sales represents the revenue generated from selling goods or services. Option C is incorrect because accounts payable represents the amount of money a company owes to its suppliers for goods or services purchased on credit. Option D is incorrect because retained earnings is the accumulated profit of a company after deducting dividends paid to shareholders. 20. When does an accountant prepare a trial balance? A. After closing the books. B. Before journalizing transactions. C. Before preparing the financial statements. D. After the financial statements are prepared. Do you know the answer? Correct answer, C. Before preparing the financial statements. Explanation. Option C is correct because a trial balance is a list of all the accounts in a company's general ledger and their debit or credit balances at a specific point in time. Accountants usually prepare a trial balance after all the transactions for the period have been journalized and posted to the ledger accounts, but before they create the main financial statements. The main purpose is to check if the total debits equal the total credits, which helps find some types of errors before the statements are made. Option A is incorrect because that describes a post-closing trial balance. Option B is incorrect because it is too early in the accounting cycle. Transactions must be recorded first. Option D is incorrect because it is too late for its primary purpose, which is to catch errors before preparing the statements. 21. Which of the following would be considered a financing activity on the statement of cash flows? A. Paying for utilities. B. Issuing common stock. C. Purchasing a building. D. Selling inventory. Do you know the answer? Correct answer, B. Issuing common stock. Explanation. Option B is correct because financing activities on the statement of cash flows show how a company gets its funding and how it repays its investors or lenders. Issuing common stock means the company is selling new shares of its ownership to investors to raise money. This inflow of cash is a financing activity. Option A is incorrect because paying for utilities is a normal day-to-day expense that is part of operating activities. Option C is incorrect because purchasing a building is an investment in a long-term asset and therefore part of investing activities. Option D is incorrect because selling inventory is a normal part of business operations and thus is an operating activity. 22. What is the impact of a debit to the inventory account? A. Increases inventory. B. Decreases inventory. C. Increases liabilities. D. Decreases liabilities. Can you guess the answer? Correct answer, A. Increases inventory. Explanation. Option A is correct because inventory is an asset account. Asset accounts increase when they are debited and decrease when they are credited. So a debit to the inventory account means the amount of inventory the company has is increasing. Option B is incorrect because a credit to the inventory account decreases the inventory balance. Option C is incorrect because debits to inventory do not directly impact liabilities. liabilities are increased by credits. Option D is incorrect because debits to inventory do not directly impact liabilities. Liabilities are increased by credits, not decreased. 23. Which type of account typically has a credit balance? A. Expenses. B. Liabilities. C. Dividends. D. Assets. Can you guess the answer? Correct answer, B. Liabilities. Explanation. Option B is correct because liability accounts, which represent what a company owes to others, like loans or accounts payable, normally have a credit balance. Liabilities increase with a credit entry and decrease with a debit entry. Option A is incorrect because expense accounts normally have debit balances, reflecting the consumption of assets or services. Option C is incorrect because dividend accounts normally have a debit balance, as dividends reduce equity. Option D is incorrect because asset accounts normally have debit balances, representing what a company owns. 24. When a company collects cash from a customer for a service not yet performed, which account is credited? A. Service revenue. B. Cash. C. Accounts receivable. D. Unearned revenue. Can you guess the answer? Correct answer, D. Unearned revenue. Explanation. Option D is correct because when a company receives cash from a customer before it has actually provided the service, it records a liability called unearned revenue. This is a liability because the company owes the customer that service in the future. Liabilities increase with a credit. Option A is incorrect because service revenue is credited when the revenue is actually earned by performing the service. Option B is incorrect because the cash account is debited when cash is received, reflecting an increase in the company's assets. Option C is incorrect because accounts receivable is used when a company provides a service on credit, not when cash is received up front. 25. How are dividends recorded in the accounting records? A. As an expense. B. As a liability. C. As a reduction to retained earnings. D. As a reduction to revenue. Can you guess the answer? Correct answer, C. As a reduction to retained earnings. Explanation. Option C is correct because dividends are payments, usually cash, that a company makes to its shareholders out of its profits and reduce the company's retained earnings. Option A is incorrect because dividends are a distribution of earnings, not an expense of running the business. Option B is incorrect because while dividends payable is a liability when dividends are declared, the ultimate effect is on retained earnings. Option D is incorrect because dividends do not affect revenue. 26. Which inventory system records inventory continuously as it is bought and sold? A. Periodic inventory system. B. Perpetual inventory system. C. Weighted average system. D. FIFO inventory system. What do you think is the answer? Correct answer, B. Perpetual inventory system. Explanation. Option B is correct because a perpetual inventory system keeps a constant, up-to-the-minute record of how much inventory a company has on hand. Every time inventory is bought or sold, the inventory records are updated immediately. This provides a continuous track of inventory levels and the cost of goods sold. Option A is incorrect because the periodic inventory system only updates inventory records after a physical count at the end of a period. Option C is incorrect because the weighted average system is an inventory costing method, not a system for tracking quantity. Option D is incorrect because the FIFO inventory system is an inventory costing method, not a system for tracking quantity. 27. How is the double declining balance depreciation method calculated? A. Cost divided by useful life. B. 2 divided by useful life times book value. C. Cost minus salvage value divided by useful life. D. 1 divided by useful life times cost. Do you know the answer? Correct answer. B. 2 divided by useful life times book value. Explanation. Option B is correct because the double declining balance method calculates depreciation by finding the straight line depreciation rate, doubling it, and multiplying it by the asset's book value at the beginning of the year. Option A is incorrect because it represents the straight line depreciation method, not the double declining balance method. Option C is incorrect because it is a variation of straight line depreciation, adjusting for salvage value but not an accelerated method like double declining balance. Option D is incorrect because it represents the straight line depreciation rate without the double declining aspect or the use of book value. 28. What is the purpose of a post-closing trial balance? A. To ensure that debits equal credits before closing entries are made. B. To verify that all nominal accounts are closed. C. To prepare for the next accounting cycle. D. To record adjustments. Can you guess the answer? Correct answer. B. To verify that all nominal accounts are closed. Explanation. Option B is correct because a post-closing trial balance is prepared after all the closing entries have been made at the end of an accounting period. Closing entries reset all the temporary nominal accounts like revenues, expenses and dividends to zero. The purpose of the post-closing trial balance is to make sure that these temporary accounts have indeed been closed out properly and that only the permanent real accounts, assets, liabilities and equity have balances remaining. It also confirms that total debits still equal total credits. Option A is incorrect because ensuring debits equal credits before closing entries describes a regular trial balance or adjusted trial balance. Option C is incorrect because preparing for the next accounting cycle is an outcome, but verifying closure is the direct purpose of the post-closing trial balance. Option D is incorrect because adjustments are done with adjusting entries before closing entries are made. 29. Which of the following is not included in the cost of inventory? A. Purchase price. B. Freight in. C. Sales commissions. D. Import duties. Can you guess the answer? Correct answer. C. Sales commissions. Explanation. Option C is correct because the cost of inventory includes all the necessary and reasonable costs to get the inventory acquired and ready for sale. Sales commissions are costs associated with selling the inventory, not with acquiring it or getting it ready for sale, and are treated as a selling expense. Option A is incorrect because the purchase price of the goods is included in the cost of inventory. Option B is incorrect because freight in, which is shipping costs to get the inventory to your business, is included in the cost of inventory. Option D is incorrect because import duties, which are taxes on imported goods, are included in the cost of inventory. 30. Which of the following is a contra-revenue account? A. Sales returns and allowances. B. Accumulated depreciation. C. Cost of goods sold. D. Prepaid expenses. Can you guess the answer? Correct answer. A. Sales returns and allowances. Explanation. Option A is correct because a contra-revenue account is an account that has a debit balance, opposite to a normal revenue account which has a credit balance, and is subtracted from gross sales revenue to arrive at net sales revenue. Sales returns and allowances is a classic example, as it records the value of goods that customers returned or for which they received a price reduction, thus reducing the total sales figure. Option B is incorrect because accumulated depreciation is a contra asset account and not a contra revenue account. Option C is incorrect because cost of goods sold is an expense account that represents the direct costs attributable to the production of the goods sold by a company. Option D is incorrect because prepaid expenses are an asset account representing payments made for goods or services to be received in the future. 31. What is the journal entry when a company makes a payment on a previously accrued liability? A. Debit accrued liability, credit cash. B. Debit cash, credit accrued liability. C. Debit expense, credit accrued liability. D. Debit accrued liability, credit accounts payable. Can you guess the answer? Correct answer, A. Debit accrued liability, credit cash. Explanation. Option A is correct because an accrued liability is an expense that the company has incurred but hasn't paid for yet, so they owe the money. When the company finally makes the payment, the liability goes down and cash also goes down because they paid out money. Option B is incorrect because debiting cash and crediting accrued liability would indicate an increase in cash and an increase in the liability, which is the opposite of what happens when a payment is made. Option C is incorrect because debiting expense and crediting accrued liability is the entry to record the accrual in the first place, not the payment. Option D is incorrect because crediting accounts payable instead of cash doesn't accurately reflect the transaction. Cash is used for payment. 32. Which of the following accounts would be considered a nominal account? A. Inventory. B. Retained earnings. C. Accounts payable. D. Interest expense. What do you think is the answer? Correct answer, D. Interest expense. Explanation. Option D is correct because nominal accounts, also called temporary accounts, track a company's financial activity for only one specific accounting period. These include all revenue accounts, all expense accounts like interest expense, and the dividends account. At the end of the accounting period, the balances of these nominal accounts are closed out and transferred to a permanent equity account, usually retained earnings. Option A is incorrect because inventory is an asset account, which is a permanent account whose balances carry forward. Option B is incorrect because retained earnings is an equity account, which is a permanent account whose balances carry forward. Option C is incorrect because accounts payable is a liability account, which is a permanent account whose balances carry forward. 33. On January 1st, a company purchased $5,000 of inventory on account. What is the correct journal entry? A. Debit inventory, credit accounts payable. B. Debit cash, credit accounts payable. C. Debit accounts payable, credit inventory. D. Debit inventory, credit cash. Do you know the answer? Correct answer, A. Debit inventory, credit accounts payable. Explanation. Option A is correct because when the company buys inventory on account, it means they received the inventory but haven't paid cash for it yet. They will pay later. The company's inventory, an asset, increases and assets increase with a debit. The company now owes money to its supplier, so its accounts payable, a liability, increases and liabilities increase with a credit. Option B is incorrect because the purchase was made on account, meaning no cash was involved in the initial transaction. Option C is incorrect because this would represent paying off the accounts payable, not the initial purchase. Option D is incorrect because this entry would be made if they paid cash immediately for the inventory, which they did not. 34. What's the impact of issuing stock on the financial statements? A. Increases liabilities, decreases equity. B. Increases assets, decreases liabilities. C. Increases assets, increases equity. D. Decreases assets, decreases equity. Do you know the answer? Correct answer, C. Increases assets, increases equity. Explanation. Option C is correct because when a company issues its stock to investors, the company receives cash from the investors, which increases assets, and the owner's stake in the company increases, increasing equity. Option A is incorrect because issuing stock increases equity, not decreases it, and it does not directly increase liabilities. Option B is incorrect because while issuing stock does increase assets, it increases equity, not decreases liabilities. Option D is incorrect because issuing stock increases both assets and equity. It doesn't decrease either. 35. When a company makes a sale on credit, which account is debited? A. Cash. B. Accounts receivable. C. Sales revenue. D. Unearned revenue. Do you know the answer? Correct answer, B. Accounts receivable. Explanation. Option B is correct because when a company sells goods or services to a customer on credit, it means the customer doesn't pay cash immediately. They will pay later. The company now has a right to receive that money in the future, which is an asset called accounts receivable. Assets increase with a debit. Option A is incorrect because cash is debited if it was a cash sale, not a sale on credit. Option C is incorrect because sales revenue is credited when a sale is made, not debited. Option D is incorrect because unearned revenue is a liability for cash received before earning the revenue, and it is not related to a credit sale. 36. What is the correct adjusting entry when a company earns revenue that was previously recorded as unearned revenue? A. Debit unearned revenue, credit service revenue. B. Debit service revenue, credit unearned revenue. C. Debit accounts receivable, credit service revenue. D. Debit cash, credit unearned revenue. Can you guess the answer? Correct answer, A. Debit unearned revenue, credit service revenue. Explanation. Option A is correct because unearned revenue is a liability account that represents money a company received from a customer before it provided the service or goods. When the company finally does the work and earns that revenue, the liability goes down because the company no longer owes that service, and liabilities decrease with a debit. The company has now earned the revenue, so service revenue increases, and revenues increase with a credit. Option B is incorrect because it reverses the correct entry. Debiting service revenue and crediting unearned revenue would be appropriate if the company needed to refund cash to a customer. Option C is incorrect because it is the journal entry for a new credit sale, not for recognizing previously unearned revenue. Option D is incorrect because it is the journal entry when cash is first received for unearned revenue, not when the revenue is earned. 37. What is goodwill classified as on the balance sheet? A. Current asset. B. Liability. C. Tangible asset. D. Intangible asset. Do you know the answer? Correct answer, D. intangible asset. Explanation: option D is correct because goodwill is an intangible asset, representing things like a company's good reputation or strong customer base. Option A is incorrect because goodwill is a long-term asset, not a current one. Option B is incorrect because goodwill represents value owned by the company, so it is an asset, not a liability. Option C is incorrect because goodwill is not a physical asset. It is an intangible asset. 38. How should research and development costs be treated in financial statements? A. Capitalized and amortized over 10 years. B. Expensed as incurred. C. Recorded as an intangible asset. D. Amortized over 20 years. Can you guess the answer? Correct answer: B. Expensed as incurred. Explanation: option B is correct because under US generally accepted accounting principles, most of the money a company spends on research and development activities should be treated as an expense in the period that the money is spent. This is mainly because it's very hard to know for sure if research and development will actually lead to a successful new product or a future benefit. So rather than recording it as an asset, it's usually expensed right away. Option A is incorrect because capitalizing and amortizing research and development costs over 10 years is generally not allowed under US generally accepted accounting principles, as the future benefit is uncertain. Option C is incorrect because research and development costs are generally not recorded as an intangible asset under US generally accepted accounting principles due to the uncertainty of future benefits. Option D is incorrect because amortizing research and development costs over 20 years is not the correct treatment, as they are generally expensed as incurred per US generally accepted accounting principles. 39. Which of the following would result in a credit to accounts payable? A. Paying for a purchase made on account. B. Purchasing inventory on credit. C. Returning goods to a supplier. D. Recording depreciation. What do you think is the answer? Correct answer: B. Purchasing inventory on credit. Explanation: option B is correct because accounts payable is a liability account that represents money a company owes to its suppliers for things it bought on account or on credit. When a company makes a new purchase on credit, its obligation to pay goes up. Liabilities increase with a credit, so accounts payable would be credited. Option A is incorrect because paying for a purchase made on account decreases the amount owed and would result in a debit to accounts payable. Option C is incorrect because returning goods to a supplier decreases the amount owed and would also result in a debit to accounts payable if the original purchase was on account. Option D is incorrect because recording depreciation is unrelated to accounts payable, as it involves allocating the cost of an asset over its useful life. 40. Which of the following is classified as a non-current asset? A. Prepaid insurance. B. Accounts receivable. C. Office building. D. Inventory. Do you know the answer? Correct answer: C. Office building. Explanation: option C is correct because a non-current asset, also called a long-term asset or fixed asset, is something valuable that a company owns and expects to use or keep for more than 1 year. An office building is a classic example because a company will use it for many years to run its business. Option A is incorrect because prepaid insurance is usually a current asset because it is expected to be used up within 1 year. Option B is incorrect because accounts receivable, which is money owed by customers, is usually a current asset because it is expected to be collected within 1 year. Option D is incorrect because inventory, which consists of goods to be sold, is usually a current asset because it is expected to be sold within 1 year. 41. Which account is debited when a company recognises depreciation expense? A. Cash. B. Accumulated depreciation. C. Depreciation expense. D. Equipment. Can you guess the answer? Correct answer, C. Depreciation expense. Explanation. Option C is correct because when a company records the expense of a long-term asset being used up over time, it makes a journal entry where the depreciation expense account is increased to show the cost for that period. Expenses increase with a debit. Option A is incorrect because cash is not involved when depreciation expense is recognised. Option B is incorrect because accumulated depreciation is credited, not debited, when recognising depreciation expense. Option D is incorrect because the equipment account itself is not directly debited for depreciation expense. Instead, accumulated depreciation is used to track the depreciation of the asset. 42. Which account is credited when cash is received from customers? A. Sales revenue. B. Accounts payable. C. Accounts receivable. D. Cash. Do you know the answer? Correct answer, C. Accounts receivable. Explanation. Option C is correct because when a customer pays off an amount they previously owed, accounts receivable, which is an asset, decreases and is therefore credited. Option A is incorrect because sales revenue is credited when a new sale is made, not when collecting payment for a prior sale. Option B is incorrect because accounts payable represents money owed to suppliers, not money received from customers. Option D is incorrect because cash is debited when received, as it represents an increase in the company's assets. 43. How are dividends typically recorded in the accounting records? A. As an asset. B. As a reduction in equity. C. As an expense. D. As a revenue. Do you know the answer? Correct answer, B. As a reduction in equity. Explanation. Option B is correct because dividends are payments made by a company to its shareholders out of its profits. They represent a distribution of the company's earnings and reduce the company's retained earnings, which is a part of the shareholders' equity. Option A is incorrect because dividends are a distribution of profits to owners, not something the company owns. Option C is incorrect because dividends are a distribution of profit, not a cost of operating the business. Option D is incorrect because dividends are a distribution of profits to owners, not an inflow of revenue. 44. What is the journal entry to record a payment on a note payable? A. Debit note payable. Credit cash. B. Debit cash. Credit note payable. C. Debit note payable. Credit accounts payable. D. Debit accounts receivable. Credit note payable. Do you know the answer? Correct. Answer A. Debit note payable. Credit cash. Explanation. Option A is correct because a note payable is a liability, money the company owes because it signed a formal, promissory note. When the company makes a payment on this note, the liability goes down, and cash also goes down because they paid out money. Option B is incorrect because debiting cash and crediting note payable would indicate the company received cash and increased its debt, which is the opposite of making a payment. Option C is incorrect because crediting accounts payable suggests the payment was related to a purchase on credit, not a note payable. Option D is incorrect because debiting accounts receivable and crediting note payable makes no logical sense in the context of paying down a note. 45. Which financial statement reports a company's revenues and expenses? A. Balance sheet. B. Statement of cash flows. C. Income statement. D. Statement of retained earnings. Do you know the answer? Correct answer. C. Income statement. Explanation. Option C is correct because the income statement is the financial report that shows a company's financial performance over a specific period of time. It lists all the money the company earned and all the costs it incurred to earn that money. Option A is incorrect because the balance sheet shows assets, liabilities and equity at a point in time. Option B is incorrect because the statement of cash flows shows cash movements. Option D is incorrect because the statement of retained earnings shows changes in accumulated profits. 46. What type of account is prepaid rent? A. Expense. B. Liability. C. Asset. D. Equity. Can you guess the answer? Correct answer. C. Asset. Explanation. Option C is correct because prepaid rent is when a company pays for its rent in advance. Even though cash has been paid, the company hasn't used up the benefit of that rent yet. It has the right to use the rented space for those future months. This right to a future benefit is considered an asset, specifically a current asset. As each month passes and the rent is used up, a portion of the prepaid rent will then be recorded as rent expense. Option A is incorrect because prepaid rent becomes an expense as it's used over time. Option B is incorrect because a liability represents an obligation to pay or provide something to someone else in the future, and prepaid rent doesn't fit this description. Option D is incorrect because equity represents the owner's stake in the company, which is unrelated to prepaid rent. 47. What's the correct journal entry to record the sale of goods for cash? A. Debit accounts receivable, credit sales revenue. B. Debit sales revenue, credit cash. C. Debit cash, credit sales revenue. D. Debit cash, credit accounts receivable. Can you guess the answer? Correct answer. C. Debit cash, credit sales revenue. Explanation. Option C is correct because when a company sells goods and receives cash immediately, the company's cash increases, which is recorded as a debit, and the sales revenue increases, which is recorded as a credit. Option A is incorrect because it represents the journal entry for a credit sale, not a cash sale. Option B is incorrect because it reverses the correct entry, debiting sales revenue and crediting cash, which is not appropriate for a cash sale. Option D is incorrect because it represents collecting cash from a previous credit sale, not a current cash sale. 48. Which of the following would decrease retained earnings? A. Issuing common stock. B. Paying dividends. C. Earning revenue. D. Recording depreciation. What do you think is the answer? Correct answer. B. Paying dividends. Explanation. Option B is correct because retained earnings is the part of a company's profits that it has kept and reinvested in the business over time, rather than paying out to shareholders. When a company pays dividends to its shareholders, it's distributing some of those accumulated profits, so the balance of retained earnings goes down. Option A is incorrect because issuing common stock increases equity, but through the stock accounts, not directly decreasing retained earnings. Option C is incorrect because earning revenue increases net income, which then increases retained earnings. Option D is incorrect because recording depreciation is an expense that reduces net income, which in turn reduces the amount added to retained earnings. 49. What does a credit to retained earnings represent? A. An increase in revenue. B. A decrease in liabilities. C. A decrease in equity. D. An increase in equity. Do you know the answer? Correct answer. D. An increase in equity. Explanation. Option D is correct because retained earnings is an equity account on the balance sheet. Equity accounts normally have a credit balance, and they increase when they are credited. A credit to retained earnings usually happens when the company's net income for the period is closed out and added to the retained earnings balance, thus increasing the owner's stake in the company. Option A is incorrect because revenue is a separate account that eventually increases retained earnings via net income. Option B is incorrect because a decrease in liabilities would be represented by a debit, not a credit, to a liability account. Option C is incorrect because a credit increases equity, while a debit would decrease it. 50. When is revenue recognised according to the revenue recognition principle? A. When cash is received. B. When the earnings process is substantially complete. C. When an order is placed. D. When payment is made. Do you know the answer? Correct answer. B. When the earnings process is substantially complete. Explanation. Option B is correct because the revenue recognition principle in accounting states that a company should record revenue when it has actually earned it, not necessarily when it gets the cash. Revenue is generally considered earned when the company has substantially completed what it was supposed to do to get that revenue, and when the amount of revenue can be reasonably measured. Option A is incorrect because this describes cash basis accounting, not the accrual principle for revenue recognition. Option C is incorrect because an order is too early. An order doesn't mean revenue is earned yet. Option D is incorrect because payment made by the company is about expenses, not revenue. You have reached the end of our first question set. For the free complete exam preparation, visit our website link in the description, where you find thousands more practice questions and comprehensive study guides. Thanks for studying with us today. See you in the next video.